Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 2nd, 2017. We're going to follow our report review routine. We'll start with the long-term market condition, bullish normal. On an annual basis, using weekly RSI 14, it's at 69 out of 100, the top end of neutral. It's 1 point away from tipping into overbought. On a 10-day basis, using the 10-day NDX, we are near the high end of neutral at 69 out of 100. In the market mosaic, price with respect to the 200-day moving average has backed off a little bit to white bullish at 7.41. Slope of the 50 is yellow neutral at 0.44. The ADX has pulled back to neutral with respect to strength of trend, away from strong, as the market has been stalling lately. The ATR percentage at 0.75% puts us in the middle of normal. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading at 0.968 puts us into risk off conditions. When we take that score and look at the last 5,000 trading days and compute the average and standard deviation of the indicator, that gives us the risk Z, which right now is at minus 0.46. You see here a 90-day histogram of that indicator. When it's in the red, it is unfavorable for swing trading, and we are alert to the possibility of sharp adverse volatility events. This long decline, this decay, has had us kind of in that posture for 60 or 70 days, and so we've been emphasizing more of the intraday trading, and in those cases where we do take swing trades, we are more likely to take shorter term gains rather than holding out for more, because there hasn't been much follow through, and we're more inclined to go down to the 30-minute or the 2-hour intermediate swing time frame in order to take advantage of shorter term swings in the market, which is indicated by this indicator. The monthly rebalancing occurs this week with the new leaders. You see here with Latin America, Australia, Asia less Japan, so decidedly overseas shift away from the U.S. ETF2, the theoretical exposure goes back to 100% in the model. The model portfolio remains at 100% invested. Inside the BMR, you see everything is on a buy signal on the ETF 13 and ETF 32. Only commodities, ag, and energy are in the cash position. That's price compared to its 4-month moving average. And then you see that the leaders in the clubhouse again are the globals, so a shift away from the U.S. Looking at the ETF max, when we look at the scores out of 900 ETFs, again, there's some powerful moves in the global sectors like India, Brazil, Argentina, China. Copper had a reasonable move up this week, although it is still down for the month. It's had such a strong performance over the last 6 months, though, that it remains near the top of the stack in the blend. In the S&P 500, again, what I look for are those that are excellent on the longer-term blend, but then have had extreme moves on the 1 week and or the 1 month. And I look, so something like Verlex Pharmaceuticals, which was up 20% this week, is one in which clearly is in play for some reason unknown to me, but one that I'll go take a look at to look for momentum continuation or momentum reversals. By the same token, Royal Caribbean, which has been excellent, had a downturn this week that put it into the red. So to lose 1.18% made it exceptionally poor week for that symbol, and that's why it's coded as red. So I really look for things that are in the green or the red in 1 week as ways to narrow down my focus on momentum plays. In the market health check, the vertical blue lines are 10, 20, and 30 days of look. Back here 60 and 90. The horizontal red lines are support levels, which were once resistance levels, and they give us not only places where we expect to find support like it did earlier this week, but also places where if it cracks, we can now estimate reasonable downside targets as price would then move to the next lower level of support. The 10-period RAF regression channel is basically flat, as is the 30, and price is right exactly in the middle of that. Both of those channels, along with sitting right on the Bollinger Band mean, which is starting to flatten out. And so this has been almost 30 days of sideways, no follow-through, as I think politics getting more difficult in Washington and the Trump bump is over. That's what I attribute most of this to. And so now it's getting tougher, and you're seeing some significant challenges now to the gains that have been made here, and I take those as the market testing for weak hands. But it's exactly in the middle of all measures, and so there is no prediction as to one way or the other. This is a market that is perfectly poised to move up another leg after 30 days of sideways chop, or to start collapsing back towards these lower levels and putting all of these gains at risk. I think the realistic one at 228 is a really important support level. It would hold this previous support and would negate all of these gains. Although there was a nice rebound off of this one here, which showed some evidence of people willing to buy the new strength leaders. You can see the slope of the 30-period regression line indicated in this sine wave looking animal here. You can see it just tipped into the negative below this dotted line on the zero line, and so now that 30 has just rolled over, and that puts the entire move of the last 3 months into perspective and says that we are now in the pause that refreshes. You can see the 200-day moving average has pulled back into view, and these last 4 days have made us just almost overbought on the percent R. But these little gains in here have also put the percent price oscillator ready to resume its upward move. So I believe there's an equally strong case that can be made for swing moves in either direction, and so we'll be postured to start taking advantage of those. I will really take advantage of anything on the downside because of the that risk Z indicator is suggesting the increased probability of sharp downward moves. Looking at ETF2 model now, all of the broad indexes are on a buy signal that puts us at 100% invested, 0% cash in the allocation model, up from 90-10. The globals at 67 are better than the S&P at 67. The tie goes to the runner. It was stronger last week, so we're going to give it one more chance in the lead position. Inside the U.S., the technology, then the large caps, then the mid caps, then the small caps. The two strongest sectors are U.S. Technology and the globals of EFA, and the two weakest are the Latin America and European 350. You can see that in the U.S. sectors, energy is really suffering, while technology has resumed the leadership or taken over the leadership posture from the financials. Looking at the world market model, we have half the U.S. above average, but the small caps, and then the growth mid and smalls below average. The Dow exceptionally weak here in the red. Haven't seen that for a long while. Europe starting to resume strength, and Japan, and then selective areas like Philippines and South Korea in Asia dominating. Canada, Mexico, Brazil looking good as our emerging markets. U.S. real estate lagging, corporate bonds ahead of the game, gold and silver above average as our commodities. You can see here the tech strength in the U.S. is not reflected in the global strength, and I attribute that mostly to the Apple effect in Facebook. So let's be careful there in tech. In the ETF 30, the top 30, South Korea, the Dow Jones Select Dividends, Russia and biotech are continuing to dominate. New leaders, that's shown by green in the strength and white in the consistency. Japan total dividend and in India. Real strong move here in the UK, maybe a response to Brexit. Some popularity there. And then some weakness, the Dow Jones financials, you can see, used to be green in the consistency, that's the 10-week average, but have gone into the white on strength. So that's a reflection of sector rotation away from financials, which were overheated, and moving into technology. The Dow 30, same analysis. The leaders continue to lead. American Express, Intel, Coke, Microsoft, Visa as the top 5, joined now by McDonald's. United Health starting to suffer a little bit here, white and green. And then the 3 in red across the board here, Verizon, Disney, and Exxon. So I like to look for the extremes for the next big moves. ETF liquidity, just for your reference, the ones that show both tremendous daily dollar liquidity as well as the ones in green are the most relatively volatile intraday for trading. Shifting to the daily report now. Quite a few in the auto framer testing out well, and lots to choose from here in channeling. 5 days down, triple screen. Johnson & Johnson, United Health, all showing potential. In the tactical summary for the Dow, you can see we got quite a few auto framers that are better than 3-1. Good number of frog candidates showing up, and then 3 in the RSI 2, less than 10. That makes Johnson & Johnson, Verizon especially interesting. Johnson & Johnson is channeling, 5-day down, triple screen, max pain, and range compression, and 4-1 on the auto framer. So that one ought to be on your short list for certain. Inside the ETF 30, fewer candidates here in the formal signals, but still quite a few good ones in the auto framers. I'm looking at emerging markets, healthcare, and the Dow as places to focus my short-term attention. Here's the mechanical auto framer with all the key data you need to frame your trades and the reward to risk ratios based on a test of the 10-day high. These regression line fractal frameworks, these are the ones that where there is the greatest difference of opinion between the trader's price, which we take to be the daily 10-period regression line, and the long-term fair value, which is we take to be the 270 regression line. So that difference in opinion is then expressed in the numbers of ATRs in difference between them. So McDonald's is in the red, 8 ATRs below its long-term fair value. So that gives some value plays there. The daily squeezes, these are the ones where the volatility of the last 30 days compared to Friday's price action gives us the opportunity for a one-day pop. So this is where the daily range from the last from Friday was so small compared to the average volatility that it gives the potential for a nice pop if we're using the range risk as our unit of risk. So Target, healthcare, Google, there's the diamonds as well. You can see the 30-period regression line is basically flattened out. We are at the long-term average here. You can see that we were given warning about a change in the trend condition almost 20 days ago when it went from climbing steadily up to getting flat. And so this indicator of the 30-period regression line slope has been our friend time and again in catching those turning points. You can see how the market has pulled back towards its 200-day moving average, almost 2 full standard deviations. That's how big that move has been. And I'm just going to flash through the remainder of these. You can stop the tape if you need for computations. I want to look at the slopes. of the three regression lines, the 10, 30, and 90. The 90 continues to roll over. That's the steam coming out of that overheated market from the Trump bump. The 30 has already come back to the zero line and slightly below, although the last 4 days have given a little pause that refreshes, which makes the argument that this is going to find support here at the lower slope of the river. But we're stuck in a narrowing river after 30 days of sideways. The last time it did that, there was a nice leg up, and so that was a 10-point move. So there is the potential for a move to 245 should this recent swing low actually be support. So that's the argument to the upside. The argument to the downside is that as politics gets tougher, if this fails, it's back to 225 and back to the previous long-term support level. So in my view, with the market being exactly in the middle of all those channel indicators, there is a slight bias to the upside because it's a bull market, but the potential for short, sharp, adverse moves is certainly there, and that puts me in the position of really respecting the shorter-term trading more so. I'm looking to make my money there. So that's everything I wanted to cover today. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.